Over the last few weeks, I've noticed increasing nervousness amongst the property investors I speak to. And it's not just the beginning investors wondering whether they should enter the market. I've also noticed some concern from investors with substantial property portfolios. Only yesterday I got a phone call from a professional colleague who's been investing for years, but now has the jitters after reading the US economic commentator Harry Dent's warning that the world's economies are going to fall into recession again and the Australian property bubble is going to burst, causing prices to come down by something in the order of 40%. Is he right? Are our property markets going to crash? Well, before I give you my thoughts for what they're worth, let me just quickly remind you that in the end of October, I'm going to run my once a year Real World Real Estate Workshop. It's Australia's longest running advanced property training. So if you want to take your property investment to the next level, if you want to learn from some experts who are real world experts, taking advantage of the current markets, giving you real world techniques, come and join us for 3 days and learn the fundamentals of property renovations, property development, property research. Join the big league and take advantage of the property markets. Anyway, back to the question I was mentioning a moment ago. Is it still worth investing in property? Let me share some concerns I've heard others say over the last few weeks. Some are worried property prices have been flat for a while now, and that could indicate that they've just gone too high, they're not going to go up for a while and they're going to now drop. Others are concerned they may have been priced out of the market because it's already too high and hard to get in. Yet others are anxious about all those issues playing out overseas and how this could affect us here in Australia. They recognise that we're now dependent upon China, and they wonder, what if the Chinese juggernaut slows down? Look, I understand why so many investors are nervous today. If you think about it, it really wasn't that long ago, while the rest of the world was suffering after the GFC, that back here in Australia we avoided going into recession. We felt confident. In fact, some of us felt a little bit smug. We thought the worst was behind us. With all the good news in the media at that time, some buyers were taking advantage of our property markets and set some of our markets on fire. But for most of this year, the messages were different, weren't they? It wasn't just good news. There was bad news followed by good news followed by some mixed messages. Most people, even some experts, don't know exactly what's happening, or more importantly, what's coming next. So no wonder most property investors haven't got any idea what's going on. Well, while the Australian economy has performed well and is likely to continue to do so, we don't operate in a vacuum. We're part of a global economy, one that's still having some problems. Look, America's taking a bit longer than expected to work its way out of its economic problems. It's got a long way to go. And the extent of the problems in Europe are bigger than many anticipated. And it's likely we're going to see some sovereign defaults in the coming months. Now, if history repeats itself, there's going to be plenty more surprises ahead. Probably going to have some shocks too. And these are likely to have a negative impact on our Australian property markets, and in particular our stock markets and our financial markets. But the good news is Australia's ready for almost anything the world can throw at us. We've been battening down the hatches, anticipating further financial problems. As a country, we've got really low debt rates. The International Monetary Fund estimates our debts at 24% of our GDP, our gross domestic product, as opposed to America where it's 100% and Greece where the debts are 150% of the GDP. And even though we've got a small budget deficit, our government could easily spend its way out of another economic crisis. And of course the Reserve Bank's got the ability to lower interest rates to help stimulate our economy, as it's done in the past. At the same time, the average household is in much better shape than it was a few years ago. We're saving more than ever, aren't we? On average, we're stashing away about 10, 11, 12% of our disposable income after tax. We're paying down our mortgages, we're paying off our credit cards, we're getting our houses into shipshape. And while small retailers are battling, many of our larger companies are in a strong financial position, particularly our banks, who've bolstered their balance sheets. Now, this means our banks are no longer as dependent on overseas funds as they could keep lending even if overseas interbank lending dries up. So, all these talks about property market crash, let's think about it. What could cause a property market to crash? You see, despite all the predictions of a property collapse, over the past year, our capital city values fell by only about 3.2% according to the latest figures from RP data. Okay, clearly we're at that stage of the property cycle where prices are going to be flat for a while, and some properties are going to still fall further. But that doesn't mean property markets are going to crash. If you look at it logically, there's only 4 things that could make our property markets collapse. Number 1, a recession. You know, when people lose confidence in the future and stop spending. But no one I know in Australia is expecting us to have a recession in the next few years. Well, not with the mother of all resources booms buoying up our economy. The second thing that could cause our property markets to crash is high unemployment. You know, when people can't afford to keep their mortgage payments anymore, they just give away their homes at any price. Again, there's no evidence this is likely. If anything, we've got a shortage of skilled labour. The third thing that could cause our property markets to crash are higher interest rates. But interest rates are likely to remain steady or fall for a while over the next year anyway. So the risk of this to our property markets has been eliminated. And the fourth thing that could cause our property markets to crash is an oversupply of property. Now, too many new properties built by exuberant property developers on the Gold Coast has shown what an oversupply can do. It causes property prices to collapse. But other than in selected areas like Melbourne, in the CBD of Melbourne, and the Brisbane CBD, where there's an oversupply living, we don't have more properties than buyers or tenants. Look, sure, property prices got a little ahead of themselves in some areas, but putting all this together means it's more likely that our property markets are going to remain flat for a while as they get back into equilibrium, in contrast to a sudden sharp fall, as some doomsayers are predicting. Think about it. If property values start to fall significantly, it's unlikely the government or the Reserve Bank would allow such a correction to occur. What they're going to do is introduce a stimulatory package or drop interest rates, just like they've done in the past. Now, I know there's all this talk about affordability. Sure, it's hard for some first-home buyers to get into the property game, but that's nothing new. Despite what some are suggesting, I know one economist that I respect, Paul Boxham, who was a former Reserve Bank economist and now works with HSBC. He suggested that since late 2003, the dwelling price to income ratios has really been much the same, so it hasn't got out of kilter. He's forecasting growth in disposable income of our households to be about 5% a year over the next couple of years, as a result of strong employment growth and wages growth, and he's suggesting house prices are going to grow at that sort of pace, you know, in line with disposable income in the next couple of years. Those people who have loans against properties that have gone up in value. So in general, Australians hold about 80% equity in their dwellings, even higher if it's their principal place of residence. So leveraging isn't going to be a big issue for the majority of Australians. Only a small group have overcommitted. You know, I think that unless our banking system collapses, I can't see house prices across Australia losing half their current value in a short sharp crash. Okay, so what should you do as a property investor? Firstly, it's worth remembering that the fundamentals for our property markets are sound. We've got a strong economy, full employment, rising wages, lowish interest rates, a growing population, and we're not building enough of the right type of houses, not to meet the growing demand. We're building too many houses in some areas, but not enough where people want them. But one important factor that boosted the markets in the past is now missing, and that's consumer confidence. The growth of our property markets, especially in some segments of Melbourne and Sydney, the growth was just unsustainable. In some ways, the property markets got a bit ahead of themselves. So they're now taking a breather, and this is normal. Property prices don't increase in a straight line. They go up, they go down, they have little booms, they have little breathers. Sometimes they drop a bit, and then they pick up again. But of course, not all properties are going to react the same. Currently, the upper end of the market, the more expensive properties, are suffering, and prices have dropped back significantly in many of our expensive suburbs. The lower end and cheaper houses, they're holding their own, but they've never been as volatile as the upper end. But by the way, this doesn't make them better areas in which to invest. In general, these suburbs don't exhibit the strong capital growth that well-located properties in the middle and upper price brackets do over the long term. Interestingly, those properties in the middle price range, well, they've varied in performance. There's still a scarcity for well-located properties for sale. This means well-located homes and apartments are still being snapped up by owner-occupiers in particular and investors. On the other hand, secondary properties, and there are a lot of those for sale, just aren't attracting buyers. So back to the question I asked right at the beginning, is property a good investment? My view can be summed up as follows. Number one, I've really got strong positive views on our property markets in most of our capital cities in the medium to long term. But number two, I am aware of a potential short-term problem in our markets related to poor market sentiment, which means you should be looking for properties at the right price, in the right location, with the right rental income. You should be looking for the sort of property you'd be happy to hold in your portfolio in the long term that's bought at sufficiently below intrinsic value. So even if property values do fall a bit further, you've still bought well. Now, just to make things clear, my strategy for this time of cycle is to continue to do what I've been talking about and doing personally for a long time. That's buy the right type of property, one with an element of scarcity, which will always be appealing to owner-occupiers who push up prices as tenants, as well as tenants. Number two, buy at the right price. Currently this is below intrinsic value. The type of price, and even if the market dropped a little bit further, I don't think it will in most areas, but it'll drop a bit more. But even if it did, you're going to be covered. And number three, buy it in the area that's always outperformed the market. Strong areas. And then only buy the sort of property to which you can add value. I want you to be able to manufacture some capital growth through renovations or redevelopment. Are you ready to exploit the opportunities that will arise from this market lull? Because if you really want to take advantage of what's happening and get ahead of the pack, I really recommend you join me for 3 days at this year's Real World Real Estate Workshop that I'm going to be holding in October on the 21st to the 23rd. It's Australia's longest running advanced property training, and it's going to be your chance to invest 3 powerful days and learn renovation and development strategies that experienced property investors are currently using around Australia to manufacture capital growth. And it also gives them strong rental return that allows you to cope with today's challenging property markets. It's your chance to take your property investment to the next level. So click on the link below to get full details and read about all the bonuses, including my money back guarantee. In the meantime, I'm going to keep you up to date on how to take advantage of the changing market in future updates like this. But it's probably appropriate to remind you that in changing times like we're experiencing, no one can quite help you like the independent property investment strategists at Metropole. Remember, our multi-award winning team of property strategists at Metropole have no properties to sell, so their advice can be independent, it can be unbiased. So if you really want to find out a bit more about what's happening in your local market, why don't you join us at a free property briefing in our offices in Melbourne, Sydney, Brisbane, or with our associates in Perth. Just click on the other link down below there and reserve your place. Of course, I'll keep you up to date with what's happening in the market in future updates. But there's so much happening on a daily basis. I now write a short daily blog. That's different to the normal subscription newsletter. So if you want to get my daily updates, just click on the Michael's blog link at the top there. And I look forward to sending you another update in a fortnight. In the meantime, have a great week. Make it a great week. This is Michael Yardney.